Most traders don't lose money because they're wrong. They lose money because they refuse to accept being wrong. And that's exactly why they double down. You enter a trade. Price moves against you. Nothing unusual. This is part of the system. But then something changes. Not in the market. In you. Your position is now negative. And suddenly the trade is no longer just a trade. It becomes a judgment. If you close it, you were wrong. This is where the real mechanism starts. The brain doesn't treat losses as financial events. It treats them as identity threats. Being wrong feels like losing status, control, competence. So instead of exiting, you protect your identity. You add more to the position. Not because the setup improved, but because the pain increased. This is escalation of commitment. The worse it gets, the harder it becomes to stop. Now, a second mechanism activates. If price reverses, you don't just recover. You prove yourself right. That anticipation releases dopamine. Hope starts to feel logical. Adding more feels strategic. But it isn't. At this point, perception shifts. You start filtering information, ignoring risk, focusing only on signs of reversal. This is not analysis anymore. It's emotional defense. The position gets bigger. The risk increases. But your ability to exit decreases. Because now, closing means accepting a larger mistake. So you stay. Later, it looks obvious. You should have cut the loss early. But in the moment, you weren't managing a trade. You were managing discomfort. Doubling down is not confidence. It's resistance to being wrong. And the more you resist reality, the more expensive it becomes. The problem is not that you lose. The problem is that you try to avoid realizing the loss. And in trading, avoiding small losses is what creates big ones.